As of 12:55 p.m. on Thursday, December 18, 2025, SMX Security Matters PLC is trading at $131.49 on the NASDAQ, showing a significant intraday gain of $5.30 or 4.20%. Most people looking at this price action see a high volatility microcap company enjoying a temporary bounce, but the reality is far more complex than a simple daily percentage move. While the broader market might be watching the latest swings in Apple stock or waiting for a breakout in Nvidia stock, the institutional movement beneath SMX is signaling a structural shift in how physical assets are valued in a digital economy. The immediate insight you need to grasp is that this current price movement isn't just about a successful pilot program or a press release. It is the market beginning to price in the identity as a service model for the first time. We are seeing a transition where a material's origin is no longer a matter of trust, but a matter of forensic data, and that data is being treated as a new form of collateral. The general expectation for a stock like SMX, especially after its recent reverse split in November, is that it would follow the typical penny stock trajectory, spike on news and then slowly bleed out as retail interest fades. Many investors looking for investment help through traditional channels, or even those using a Schwab Intelligent Portfolios setup, might see this volatility and steer clear, labeling it as too speculative for a balanced individual brokerage account. The common belief is that these small-scale tech plays are more about momentum than fundamentals. However, the reality we are seeing on the tape today challenges that assumption. We are witnessing record volumes that far exceed the 2.5 million daily average seen just weeks ago, and this volume isn't just coming from retail traders on a SoFi trading platform or people buying fractional shares on a Robinhood app. We are seeing signs of institutional accumulation that suggests a repositioning of the company's valuation floor. In the last few trading sessions, the daily swings have been nothing short of violent. Just look at the historical data from the start of December when the stock moved from $50 to over $450 in a matter of days before settling back into its current range. This isn't random. It's the result of a massive tension between expectation and reality regarding the company's capital structure. On one hand, you have the expectation of dilution after the announcement of a $111.5 million equity purchase agreement. On the other, the reality is that the deal was structured to be incredibly flexible, allowing SMX to control the pace of capital inflow without the immediate death spiral mechanics often associated with microcap financing. When investors on Interactive Brokers or Fidelity brokerage accounts saw the news of the $11.5 million promissory note, many expected an immediate dump. Instead, the stock stabilized because the company realized it now has the financial muscle to execute on its global pilot programs without having to constantly return to the well for more cash. The trading volume today is particularly interesting when compared to the sector momentum. While the tech-heavy NASDAQ is seeing some pressure, SMX is decoupling from the broader indices. This is often a sign of a repricing event, where the company is being evaluated on its specific catalysts rather than macroeconomic headwinds. We are seeing a high level of short interest being covered, which is creating a localized squeeze. If you are using a Fidelity trading platform or checking your watch lists on the Robinhood mobile app, you might notice that the bid-ask spreads are thinning out despite the volatility. This indicates that liquidity is improving and the market is finding a real price discovery zone after the massive 300% surge we saw earlier this month. Now, let's step back and look at what this company actually does to understand why the market is reacting this way. SMX specializes in molecular-based material authentication. They have developed a way to embed hidden chemical barcodes into everything from gold and rubber to plastics and textiles. Unlike a QR code or a serial number that can be removed or faked, this identity lives inside the material itself. It can survive being melted, shredded, or chemically recycled. This is the foundational technology for what they call the digital product passport. The business model is shifting from selling the markers to becoming the verification layer for global supply chains. They aren't just a tech company, they are becoming the auditor of physical truth. Earlier reports showed a heavy cash burn, but the recent $111.5 million deal and the successful cotton traceability pilot in Paris and Singapore have changed the narrative. They proved that they can track a fiber from a field in a developing nation all the way to a finished high-end garment, verifying its origin and recycled content at every step. If you look at the older financial reports, the net loss of $11.82 million in the first half of 2025 was a major red flag for many. It's why you saw the stock hit such low levels before the recent rally. But that loss was the price of building the infrastructure that is now being deployed at a national level. Singapore's A-Star and major precious metals trade hubs in Dubai aren't just looking for better spreadsheets, they are looking for forensic proof. This is where the gap between expectation and reality is widest. The market expected a niche laboratory company, but the reality is an infrastructure play that addresses a trillion-dollar problem: supply chain fraud and greenwashing. For those of you managing your own self-investing strategy or perhaps looking for fidelity ETFs that might eventually include specialized tech sectors, it's worth noting the institutional activity here. We are seeing moves that suggest smart money is treating SMX as a hedge against the rising costs of regulatory compliance in Europe and the US. With new digital passport regulations coming into play, companies that cannot prove their material origins are going to face massive penalties. SMX provides the only scalable way to avoid those risks. Comment below how many shares of SMX you currently hold, or if you are waiting for a pullback before entering. Looking at the future outlook, there are two main scenarios that could play out. The first is a continuation of this repricing event. If SMX can convert its pilot programs into long-term commercial contracts with recurring revenue, the current market cap of roughly $138 million will look very small compared to the addressable market. We are talking about becoming the standard for the global gold industry and the circular economy for plastics. The second scenario is the risk of execution. Scaling a technology across 4 continents simultaneously is a massive operational challenge. The company has to manage its new capital facility without destroying shareholder value. If the conversion price of their new notes drops too low, the resulting dilution could cap any further upside. However, there is a catalyst that many are overlooking. Part of the new equity deal allows SMX to use proceeds to acquire digital reserve assets. This is a move similar to what we've seen with larger tech firms, and it creates a valuation floor that is independent of the core business operations. If the company builds a treasury of liquid assets, while its technology becomes the memory system for industrial materials, you have a very powerful combination. It changes the company from a speculative tech play into a diversified asset manager with a proprietary technology edge. This is the kind of nuance you won't necessarily find by just looking at the top-line numbers on a Robinhood app or using a basic robo-advisor like the SoFi robo-advisor. It requires a deeper look into the filings and the structural shifts in global trade. Interactive brokers' fees and account requirements might make it harder for the casual retail investor to get involved in some of these high-volatility microcaps, but for those who are focused on online investing and have the stomach for the swings, the tension here is exactly what drives long-term alpha. The market expects volatility and potential failure. The reality is showing a company that has successfully navigated a reverse split, secured a massive capital line, and proved its technology on a global stage in the same quarter. As we look toward the start of 2026, the real test for SMX will be revenue clarity. The partnerships in Spain, France, and the Middle East need to start showing up on the bottom line. If we see a transition from successful pilots to quarterly revenue growth, the short sellers who have been betting against this company will have no choice but to exit their positions, potentially fueling another leg up. The current price of $131.49 is a reflection of this uncertainty. It's high enough to show that the market believes in the potential, but low enough to show that there is still significant skepticism about the long-term execution. In summary, the central insight here is that SMX has successfully moved from the concept phase to the infrastructure phase. The expectation was that the company would struggle with listing requirements and cash flow, but the reality is that they have built a global verification mesh that is now attracting national-level interest and institutional-scale capital. While others are distracted by the daily noise of the S&P 500 or the latest update on NVIDIA stock, the real opportunity is often found in these repricing events where a company's fundamental value is finally being recognized by the broader market. The depth of their molecular marking technology and its integration into the digital product passport ecosystem makes this more than just a momentum trade. It is a fundamental bet on the future of authenticated commerce. Whether you are using Fidelity Wealth Management for your long-term goals or a Robinhood stock trading account for shorter-term plays, understanding the gap between market narrative and operational reality is the key to navigating this level of volatility.